Welcome to the Cashflow Ninja, the podcast sharing how to create and grow income streams and manage, multiply, and protect your wealth in the new economy. Are you tired of trading your time for money? Do you desire freedom today instead of retirement in 10, 20, or 30 years? I'm MC Laubscher, and this is the Cashflow Ninja. This is Cashflow Ninja. I'm MC Laubscher. Thank you so much for spending your most valuable resource, your time, once again with me on the show. I've got another fantastic show with a great guest, returning guest, Richard Duncan. He has a newsletter called MacroWatch, and Richard is an economist. I think you guys will really enjoy it. We got a lot of great feedback from his previous appearance on the show, which you can access at cashflowninja.com, because Richard, from an economic standpoint, really can share insights and thoughts to us, which a lot of us wouldn't have or have access to regularly. He's worked at the IMF, the World Bank, a lot of different places in the world, and is currently living abroad as well. Without further ado, Richard, welcome back to the show.
MC, thank you for having me back.
For our new listeners, can you please share a little bit of your background with them? I touched on, why it's fantastic to get your insights, but if you could just share a little bit how you ended up where you ended up on the other side of the world in Thailand, and maybe touch on some of the things that I didn't touch on.
Okay, so yes, I'm an American. I was born in Kentucky. I went to Vanderbilt, and then after Vanderbilt, I ended up by chance backpacking around the world for a year in 1983 and 1984. I saw Europe and the Middle East and Southeast Asia. And so that was an enormous life-changing development for me, because by seeing Southeast Asia, I realized it was booming economically. And I went back to business school at Babson College for a couple of years. And then when that was over, I flew to Hong Kong and found a job as a securities analyst, doing research on all the listed Hong Kong stocks. And from there, I've moved around from Hong Kong to Singapore to Thailand a few times each, working for stockbroking companies and fund management companies. I was in Washington for a couple of years at the World Bank after the Asia crisis in 98, 99, 2000. And then I was the global head of investment strategy for ABN AMRO Asset Management, based in London, in 2006 and 7. And then along the way, I've written 3 books so far. The most well-known was The Dollar Crisis: Causes, Consequences, Cures. So by living in Asia, that's been an enormous advantage for me, because not only have I been able to look at a number of different economies and countries and economic cycles, but many of the things that I've seen in Asia have been very useful later on, because those sorts of economic crises that struck Asia have subsequently hit the rest of the world. So by experiencing the Asia crisis in Thailand in the mid-90s, that was enormously helpful to me in understanding what was to come later in the United States, particularly with the crisis of 2008. And so that's what I wrote about in The Dollar Crisis, my concerns that we were headed for a great economic crisis based on what I'd seen developing in Asia in the 90s.
Let's stay on that for a second, because a lot of people around the world know you for your great piece of work that you did in that book, The Dollar Crisis. What were some of the things that you were seeing that you started to put together, which is now coming to fruition? But what were the things back then that you're saying, this is not going to end well, because the same things are happening in the United States, which was happening during the Asian crisis?
Well, so what I saw in Thailand, and I lived in Thailand from 1990 until 1996, and it truly was an economic miracle initially in the early 90s, but it clearly was an economic bubble sometime around 93, 94. And the bubble didn't pop until 97. But when it did pop, the stock market fell 95% in dollar terms. And the and the GDP contracted by 9% in 1998. And so I had lots of time to try to understand what was blowing Thailand into an economic bubble. And it very clearly was enormous amounts of credit growth, credit expansion. And most of the reason that the credit was growing so rapidly is that a lot of foreign money was flooding into Thailand. It was possible to borrow money in Singapore at just 2 or 3% and put it on deposit in Thailand at 12 or 13%, if not more. And everyone believed the currency was pegged. So, of course, many international investors took advantage of that opportunity. And also there was a tremendous investment in Thai stocks. And so huge amounts of money flooded into Thailand, went into deposit into Thai banks. So the Thai banks then had to lend out those deposits, and resulting in a surge of credit expansion year after year. That money was borrowed by businesses. They all quadrupled their capacity, regardless of whatever industry they were in. But before long, most of them had far too much capacity. This was most visible in the property sector, where there was an enormous glut of excess empty buildings, residential buildings, office buildings. So rents plummeted, but the price of all these goods that were being manufactured, prices dropped. So the corporations' profits became losses. They weren't able to repay their banks. So not only did the corporations begin to fail, but the banks began to fail. And then the peg of the baht came undone, and the currency collapsed. And suddenly all this money that had rushed in rushed back out. So it was very clearly caused by enormous amounts of capital flows coming into country, creating an enormous credit bubble that popped. And so that it turned out not just to be Thailand, but it was also the same thing was happening in Korea, Indonesia, and Malaysia. And 3 out of those 4 required bailouts from the IMF. And upon further research, I realized that the same thing had happened to Japan earlier on. Japan's bubble popped in 1990. And then later, for somewhat different reasons, but the US was blown into a bubble due to, in large part, to foreign capital inflows into the United States coming from foreign central banks. I mean, it's an interesting topic to explore, but I'm not sure if you want to go into that or not.
No, it's very interesting if you do want to explore a little bit.
Okay, well, sure. So in the case of the United States, the real theme of the dollar crisis, my book, was that the global economy was being destabilized by very large trade imbalances. Back when we were on the Bretton Woods system, which was a quasi-gold standard that had been set up at the end of World War II to try to replicate the gold standard, under that system and under the gold standard that preceded it, large trade imbalances between countries just weren't possible. Because if one country had a very large trade deficit with another country, it had to send its gold to that other country to pay for its trade deficit. And pretty soon, if it persisted for too long, the country would run out of gold. And since gold was money, of course, the economy would go into crisis and trade would come back into balance very quickly. But once the Bretton Woods system broke down in 1971, then it very quickly, the US discovered that it could run very large trade deficits with other countries. And it didn't have to pay with gold anymore. It could just pay with paper dollars, or more commonly, treasury bonds, US government bonds denominated in paper dollars. So up until that point, the US, there were no large trade deficits. But by the mid-1980s, the trade deficit in the US had blown out to 3.5% of US GDP. And by 2006, at the peak, it was 6% of GDP. That was $800 billion in that 1 year alone. Now, so nothing like this had ever occurred before. Of course, as the US ran large trade deficits, that allowed its trading partners to run very large trade surpluses, countries like Japan and Germany and later on China. And so, of course, they benefited enormously. All of the Asian countries were and still are major exporters to the United States, and they all boomed. The Asian miracle was all about manufacturing goods and selling them to Americans. That's how Asia was transformed from, developing countries into modern Asia today, where China's soon going to overtake the United States as the largest economy in the world, and perhaps technologically and militarily as well. This was all based on exporting to the US. Now, but for this to continue, the way that it worked was normally, if a country had a big trade surplus, then its currency should have appreciated. Because let's take the case of China. China's trade surplus with the US a few years ago got as high as $400 billion a year. So Chinese companies were selling their goods in the United States, earning $400 billion in dollars. Those companies took that $400 billion back to China. They wanted to convert it into the local currency, the Chinese yuan. But had they done that in a free market, buying so many yuan would have pushed the yuan to a very high level, and that would have made China uncompetitive in the export market. So its exports would have stopped growing and probably started contracting, and China's economy would have stopped growing and probably started contracting. So to prevent that from happening, China's central bank, the People's Bank of China, it bought all the dollars coming into China at a fixed exchange rate. So that allowed the manufacturers who earned the dollars to convert the dollars into yuan and do anything that it wanted with them. But sooner or later, their money ended up on deposit in Chinese banks, causing rapid deposit growth, which forced the banks to have very rapid loan growth, which created this extraordinary economic boom in China, which eventually turned into a great bubble that China is today. But the point is, where did the People's Bank of China get the $400 billion that year that it used? Where did they get the $400 billion worth of their own currency, Chinese yuan? Where did that money come from? Well, they're a central bank. They just created that money from thin air, in the same way that the Fed creates money when it does quantitative easing. And so they created, in that one year, 400 billion, the equivalent of $400 billion worth of yuan. And they used it to buy those $400 billion coming into China, so the currency wouldn't appreciate. Once they had bought those dollars, they needed to invest those dollars in US, because they own dollars, they had to invest them in US dollar-denominated assets, like government bonds, or corporate bonds, or bonds issued by Fannie Mae and Freddie Mac, or even stocks, but it had to be some dollar-denominated investment. So because these foreign central banks, led by China, were creating so much of their own money and buying so many dollars and then investing those dollars into the United States, that money coming into the US, that money that was created by foreign central banks from thin air, that money blew the US into a bubble. So back in 2004, 2005, 2006, as the property bubble in the US was starting to develop, the Fed hiked interest rates again and again, I think 13 times between mid-2004 and mid-2006. By 425 basis points, they hiked the federal funds rate, but the 10-year bond yield, the government bond yield, it didn't move up, which was very unusual, because normally when the Fed hikes the federal funds rate, all the interest rates move higher, more or less in line with what the Fed is doing. But the 10-year government bond yields didn't go up because China and other countries' central banks were creating so much of their own money, buying literally trillions of dollars, and then investing those trillions of dollars into US government bonds, pushing up the price of the bonds, which drove down their yields, or in other words, interest rates. So that caused the Fed to lose control over interest rates in the US. And so it couldn't stop the property bubble from developing in 2008, the bubble blew up completely, setting off up until then, what was the worst crisis since the Great Depression. But what has been most interesting is the policy response to that crisis, what we learned from the policy response. So up until that point, what I had written in the dollar crisis, that this was all leading to these trade imbalances were all leading to some sort of economic catastrophe, that more or less happened. But what surprised me afterwards, and the thing that I learned, and I think everybody else should learn and recognize, is that the policy response to the crisis of 2008 was something that I certainly couldn't have imagined, and I don't think anyone else imagined either. So what it was first of all, the government started running trillion-dollar budget deficits. Okay, that was not the surprise. The thing that was a surprise was that the Fed, the central bank in the US, created just mind-blowing amounts of money. So up until 2007, the Fed started its operations in 1914. And between 1914 and 2007, altogether, they had created roughly $900 billion, so in a century. Well, over the next 7 years, they created an additional $3.5 trillion. So the Fed expanded the amount of money it created by 5 times over 7 years by creating $3.5 trillion and using that to buy mostly government bonds to help the government finance these enormous budget deficits that it incurred to prevent the US economy from collapsing into a depression. Now, that was certainly not expected, and because everyone had been taught that when a central bank creates a lot of money, it leads to inflation. So it's an enormous taboo for the central bank to create money on a large scale. And the Fed had never created money on such a large scale before. So thinking of that just seemed impossible, because everyone believed it would have led to hyperinflation, but it didn't. They created all this money and helped finance this extraordinary expansion of government debt, which kept the US from collapsing into a Great Depression. And there was still very limited inflation, at least at the consumer price level. And so that was a tremendously successful policy response. We didn't collapse into a Great Depression. And now it's 2020, 12 years on. And up until the time of this coronavirus, things were ticking along. It wasn't an economic boom, but it certainly wasn't a depression. It wasn't even a recession. The economy was, not super strong, but it wasn't super weak either. And we'd managed to have the longest economic expansion in history up until that point without a recession, up until February of this year. So the thing that everyone has to recognize is that policy response was successful, that this expansion of government debt and all of this paper money creation didn't lead to some sort of catastrophe. It didn't lead to hyperinflation. And the reason it didn't is because of globalization. Globalization is extremely deflationary. The world population is about 8 billion people. 2 billion of them live on less than $3 a day. And so those people would be delighted to work for $10 a day. So this has held down wages in the United States, pushed wages lower. And also, as the developing countries have become developed, that's expanded their industrial capacity to the point now where there's just enormous excess capacity of everything all around the world. And so globalization has been extraordinarily deflationary. And this deflationary pressure from globalization is the reason that the paper money creation by all the central banks, not just the Fed, but all the central banks, that still didn't create any significant inflation. In fact, deflation has been a greater risk over the last decade than inflation has been. So this is really something very, very important that has occurred. Everyone needs to take note of, because it has very important policy implications for the future.
Right. And that definitely brings us to definitely the meat of the conversation of what's going to happen in the future. Just a comment on that too. That it seems that it was a much more balanced way when you had the gold, the gold standard, some gold backing after Bretton Woods. Countries, couldn't just consume; they had to produce to balance it, because, as you mentioned, gold would leave shores at the end of it to settle these trade imbalances. And the comment that if I just think about, and then that right there, that nothing ever good comes from when you consume more than you produce, right? I'm just thinking of a personal economy, and maybe our listeners and viewers can relate to it too in their own household. If you consume more than what you produce, you're going to just get further and further and further into debt. And then obviously there was a lot of financial games played, as you shared. That's a great insight of putting this all together, of where we're at. One of the things that you shared was, the economy was plugging along. One of the questions that I personally had for you that I wanted to get your insight on is, there was a lot of talk last year in September of things happening on the repo market and the Fed injecting some more money into this. So a lot of people were kind of pointing to, hey, there was already things happening last September. What was going on there for our listeners and our viewers? What do we need to know about that?
Right. Well, before we jump into the repo crisis of last September, let me just add to our preceding conversation that up until the Bretton Woods system broke down in 1971, central banks were not free to create as much money as they wanted, because the central banks had to actually own gold to back the money they created. Yeah. So in the US, really it was 1968. Up until 1968, the Fed was required to own at least 25% gold backing for every dollar that it created. Now, Congress eliminated that requirement in 1968. And then the final straw was when Nixon told the rest of the world they were no longer able to convert their dollars into US gold in 1971. But after that, not only the dollar, but all the currencies in the world ceased to be backed by gold, which meant that central banks like the Fed and the European Central Bank, which of course didn't exist then, the Bank of Japan and People's Bank of China, all of the central banks afterwards were free to create as much money as they dared. The only thing that would restrain them was the fear that money creation on a large scale would lead to high rates of inflation. So what I described earlier, these trade imbalances were perpetuated by central banks who are creating so much money. That couldn't have happened in the past. The central banks just simply couldn't have created that kind of money. And so the entire global economy was built on an explosion of credit. Credit and debt, of course, are two sides of the same coin. Total debt in the United States, by that I mean government debt, household sector debt, corporate sector debt, financial sector debt, all the debt. It first went through $1 trillion in 1964. But by 2007, 43 years later, it had expanded 50 times to $50 trillion. And that explosion of debt in the US built the world we live in. It created an enormous worldwide economic boom that literally pulled hundreds of millions of people around the world out of poverty and built cities like Shanghai from the mud. It completely transformed the world. So while households, if they ultimately they will go bankrupt if they keep spending more than they earn. But we've been living through 50 years of a global economic boom on a scale that would have been not possible had we not broken off the Bretton Woods system. This wouldn't have been possible if we still had to back dollars with gold. So there wouldn't have been a big boom, there wouldn't have been a big bubble, but then there wouldn't have been a 2008 crisis and the potential of collapsing into a depression. So our economic system since Bretton Woods broke down has been driven by credit growth. It's very different from the system that preceded it. Capitalism was driven by saving and investment. Businessmen would make investments, some of them would make a profit, they would save that profit and accumulate capital, hence capitalism, and repeat. It was driven by investment and saving, saving and investment. But that's not the way our system works anymore. Our economic system is driven by credit growth and consumption, and more credit growth and more consumption. So I call it creditism. I think creditism is a more appropriate term for our economic system now. Capitalism evolved into creditism once we stopped backing money with gold. Credit exploded.
MC Lobster here, the creator of the Cash Flow Ninja and Cash Flow Coach at Producers Wealth, where we help our clients integrate infinite banking with their business and investments. To learn how you can create your own banking system to turbocharge your investments and business in 30 days or less, go to yourownbankingsystem.com. That's yourownbankingsystem.com.
And so now, if credit in the US grows by less than 2% a year, and this is adjusted for inflation, but anytime credit grows by less than 2% a year in the US goes into recession. And it doesn't recover from recession until we have another big surge of credit expansion. So in 2008, we got to the point where the private sector couldn't take on any more debt. They were too heavily indebted. They started defaulting, credit started to contract, we started to collapse into a depression. So the government jumped in and they borrowed $12 trillion between then and now. And that government borrowing was enough to keep credit expanding, keep debt expanding, but it just barely. Credit in the US was just growing by just a little more than 2%, what I call the 2% recession threshold. Most years between, say, 2010 and 2019. And so the Fed felt in order to generate sufficient economic growth, the Fed kept interest rates extremely low and used quantitative easing round after round to push up the stock market and the property market and to drive up wealth in the country, to create a wealth effect by pushing up stock prices and property prices and thereby supplement the credit growth. So asset price inflation created by the Fed was a necessary supplement to make the US economy grow because the credit growth was really too weak to make it grow meaningfully. So we're dependent on credit growth. We must have credit growth for the economy to stay out of depression. The problem is the private sector is too heavily indebted to generate enough credit growth. So we've become more and more dependent on the Fed pushing up the stock market to generate economic growth. So this brings us up to your question about the repo crisis. Now, eventually, after 2008, the Fed kept the federal funds rate at 0 for about 8 years. And then in late 2015, they gradually started increasing the federal funds rate. They hiked it once in 2015, I think just once more a year later in 2016. Eventually, they moved the federal funds rate up to, let's say, from 0 to 2.5%. And to add insult to injury, they also started reversing quantitative easing. They introduced what is now called quantitative tightening, starting in October 2017. And quantitative tightening is the reverse of quantitative easing. So with quantitative easing, the Fed creates money and buys government bonds and pushes up the price of government bonds, which pushes down the yields on government bonds, interest rates. And lower interest rates support economic growth and push up stock prices. Quantitative tightening is the reverse. To simplify it a bit, it's the Fed selling bonds that it already owned. And when it does that, then when it sells a bond, then the price of the bond tends to go down. And so the yield on the bond tends to go up. And so interest rates were moving higher. And the Fed went too far. It should have never done the quantitative tightening. Altogether, during quantitative tightening, it destroyed about $750 billion out of the $3.5 trillion that it had created after the crisis. And so toward the end of 2018, the stock market started going into rebellion and sold off 20% in December 2018. And the Fed backed off. It very quickly stopped hiking interest rates. It said it was going to end quantitative tightening sooner than expected. And it did. And the market was happy, it recovered, and things were fine. But then in September 2019, something, we're told, started going wrong in the overnight repurchase market, the repo market. The interest rates in the overnight repo market are supposed to be quite close to the federal funds rate level, which at that time I think was still 2.5%, or maybe the Fed had cut by then. Anyway, somewhere around 2 or 2.5%. But they spiked the interest rates mysteriously for some reason in the repo market, became 4 times higher one day than they were supposed to be. And the Fed told everyone that meant there was not enough liquidity. Because of course there wasn't enough liquidity, because they've been destroying liquidity through quantitative tightening. But it's still hard to understand how there wasn't enough liquidity, because there was still an enormous amount of liquidity in the banks in terms of bank reserves relative to what had existed before quantitative easing started. The banking system had something around $1.5 trillion of reserves. And still, for some reason, supposedly that wasn't enough to make the repo market function as it was supposed to. Whether that's actually true or not, I don't know, but it's hard to understand why that wasn't enough liquidity. But in any case, the Fed then responded with what was effectively a 4th round of quantitative easing. They denied that it was quantitative easing for silly reasons, but they started creating money and buying government bonds. The only reason they said it wasn't QE is because they said this time we're buying treasury bills, which are very short-term government bonds. Whereas before they were buying government 5-year, 10-year bonds or 30-year bonds, but that was the only difference. And so they started, even before the coronavirus started, the Fed was buying, starting in October 2019, the Fed was buying $60 billion creating $60 billion a month and buying $60 billion worth of government bonds with it. The peak of the 3rd round of quantitative easing, which was the biggest round, it was $85 billion a month. So this QE4 was not far off what they were doing at the peak of QE3. And so they needed to do that because they needed to pump more liquidity into the financial markets to push the stock market still higher, or to prevent it from falling, because they needed the wealth effect to drive the economy, to keep it going, and to help finance the government's growing budget deficit. But 2019, the US budget deficit had almost grown back to $1 trillion again, which helps support the economy, but that kind of government borrowing tends to push up interest rates. So the Fed launched QE4 and helped finance the government borrowing. And of course, the stock market loved that. As soon as they announced the QE4, the stock prices went up and up again, and we hit really quite astronomical valuations on the stock market in February 2020. And that's when the coronavirus struck.
And that brings us to the coronavirus. Yeah, the other interesting thing too in the news was there was a record amount of CEOs resigning in December and January, which was kind of interesting at that stage too, which was basically at the height of that. Then the virus came. I'd like to talk a little bit about the effects of the virus, and not necessarily, just stay on the virus. Obviously, the virus right now, the United States, where I live, is opening back up. Most states are opening back up. It's going on. What do you think is going to happen? What are some of your thoughts around just what?
Beginning that I think I've had some advantages since I've lived in Asia. And yep. One, unfortunate though it is, the coronavirus hit Asia first.
Yep.
Just like SARS hit Asia quite hard back in 2003, 2004. I was living in Hong Kong then, and SARS was absolutely terrifying. And then the coronavirus, of course, started in China, and started spreading all around Asia. And it was and so suddenly people weren't going out in Thailand and Bangkok. People began wearing masks, and the economy was hit very hard. And it was not too difficult to foresee that this was going to hit the US pretty quickly in the same way. So on March 1st, I started publishing MacroWatch videos on the coronavirus. And since then, I've published, I don't know, 8 or 10 on this subject. And the first one was called Thoughts on the Coronavirus. And from the next one on March 15th was called Recession or Depression. And that was before people started calling this a depression, and before it became clear how bad it was going to be. But from very early on, my position has always been whether this is going to be just a recession or a new Great Depression depends entirely on the speed and the magnitude of the government's policy response, both in terms of government deficit spending through rescue packages, and also, so that's on the fiscal side, fiscal stimulus, but also in combination with monetary stimulus, monetary policy. How much is the Fed going to print? Now, back on March 15th, for instance, all of this was very uncertain. If the government did not spend enough and if the Fed did not print enough, then it looked very clear that the US was going to collapse into a Great Depression and probably stay there indefinitely like we did in the 1930s. But since then, the government has responded really pretty quickly, at least in the first round. They've passed rescue bills now amounting to roughly $3 trillion. And the Fed has, just this year alone, the Fed has created roughly $3 trillion, more or less in line with the amount of rescue packages that the government has launched. So the Fed, just to put this into perspective, during the first 3 rounds of quantitative easing over 7 years between 2009 and 2014, in 7 years, the Fed created $3.5 trillion. Well, now, just since September last year, the Fed has created $3.4 trillion. So just in 9 months or less, the Fed has created as much as it did in 7 years following the crisis of 2008. So this is money creation just on a mind-boggling scale, and it's going to continue. So where are we now? Well, we're still in the position, what happens next, recession or depression? Are we going to come out of this or not? It still depends on whether the government continues to follow through with large rescue bills to make sure that people continue to have money to spend and that businesses don't completely fail. Had the government not intervened in the way that it did, we would be living in a very dark world right now, because with the unemployment, 42 million people have filed for unemployment claims in the US. And those people have not all defaulted on their mortgages and their rent payments and their car payments and their credit cards, because the government has been giving them money pretty generously. Had the government not done that, then not only would all of those people be in bankruptcy, losing their homes, but all the small and medium-sized businesses, most of them would be in the process of failing, and the major corporations would be failing. And consequently, since no one would be in a position to repay the money they owe the banks, all the major banks would have failed, destroying everyone's deposits and essentially destroying the US and the global economy. We would be in a catastrophic position had the government not done what it did. So they deserve credit for acting quickly, and the Fed has also helped finance that by creating, as I mentioned, nearly $3 trillion year to date. But this is not going to be enough. They're going to have more rescue bills. And if they're not large enough, then the economy is going to deteriorate, and many of those bad things that I just described can still happen. So it's very important that the government continue to pass large-scale rescue bills, multi-trillion-dollar bills. I think the House has already passed a $3 trillion second round rescue bill. It would probably be a good idea if the Senate approves that, and sooner rather than later, so that our economy can stay intact. without this government support, the economy would completely implode and it wouldn't recover anytime, probably anytime. It wouldn't recover. It would, or at least it wouldn't recover for who knows how long. The Great Depression didn't end until World War II started.
Yeah.
And it only did then because of massive government spending, borrowing and spending. That's what ended the Depression, government borrowing and government spending and government investment. So if we allow everything to collapse now, we can have a 10-year depression that won't end until we get more government borrowing and spending and investment, or we can just have the government borrowing, spending, and investment right now and not have to live through the depression.
Or even a worst case scenario, as you mentioned, another war, a war which it looks it's already cold with China, but it becomes hot, as you mentioned, just like with World War II.
Right, yes. I mean, heaven forbid another war.
Yep. So they're going to throw a lot of money at this, and they're going to continue to have to throw a lot of money at this. What does this mean for Main Street, for a lot of our listeners and viewers out there? What is that going to look like for them in their lives, and what are some of the things that they can do to protect themselves or to position themselves and their family and their businesses?
Well, so luckily, the United States is a very, very wealthy country. The US government can afford to keep borrowing and spending to prevent the economy from collapsing. And there's nothing to stop the Fed from printing money and helping to finance this government borrowing. I mean, for example, after 2008, the crisis of 2008, as I mentioned, the Fed's assets increased by 5 times, and the government debt increased by $12 trillion. Or to take an even more extreme example, during World War II, US government debt increased 5 times in just 4 years. And the Fed's holdings of treasury bonds expanded by 11 times in 4 years. So now, looking at where we are now, let's take the 2008 example. Or let me put it this way. Right now, the US government debt is something like 110% of US GDP and climbing fast. The GDP is about $22 trillion. Japan's government debt to GDP is already 250% of GDP in Japan. So we're less than half of Japan's level of GDP, debt to GDP. So the government could borrow, in this extreme example, if it became necessary, and it won't. But even if the government had to borrow $22 trillion, the size of the GDP, to prevent the economy from collapsing, that would cause our level of government debt to GDP to double to about 220% of GDP, whereas that's still below where Japan is now. So effectively, there's nothing to restrain US government borrowing. We are in a warlike situation, and the only thing that's going to save our economy is government borrowing. And the government can afford to borrow, and so they should borrow. And already the Congressional Budget Office is projecting that the budget deficit this year is going to be $3.7 trillion instead of $1 trillion. So they're saying $3 trillion higher than it would have been, and it'll be higher next year. So if, because of this virus crisis, the US government has to borrow an extra $5 trillion or an extra $10 trillion to prevent our economy from collapsing, well, that's unfortunate, but that's just the way it's going to have to be. Because if we don't, the economy will collapse. And not only will that destroy everyone's lives, but of course, people will stop paying taxes and the government's budget deficit will explode anyway. So if the government doesn't spend money, the deficit's going to become very much larger anyway. So the government needs to keep spending money very aggressively until we get to the other side of this. And if they do, we'll get to the other side with our economy intact and everyone's personal lives largely intact. So that's what they need to do. And the Fed is going to have to print enough money essentially to pay for it all. Now, the big question in all this is this going to lead to inflation, high rates of inflation? Well, as I just said earlier, after 7 years after 2008, the Fed's total assets expanded by 5 times. And that didn't lead to high rates of inflation then. But will it now? Well, we don't know how much the Fed's going to print. And of course, they're printing it faster. They've printed $3 trillion already in less than a year. So is this going to lead to inflation or not? Well, that's the big question. Right now, we're experiencing more like deflation. You saw last month the price of oil fell below zero.
Yep.
Everyone stopped buying, and so prices are falling. And so we're going to move through a period of deflation, but when we get past that, will all this money creation lead to high rates of inflation? Well, it's not certain. Again, it's going to depend largely on globalization. If globalization were to break down, if we were to have a complete trade war, not only with China, but with everyone else, and put up trade barriers the way they did in the early 1930s, and go back to the age before we had globalization, then yes, it's very likely that all this paper money creation would lead to very high rates of inflation in the US, as it always did in the past before we had globalization. But on the other hand, if globalization persists, and it probably will, not as fully as it did before the crisis began, but for the most part, globalization probably will survive.
Life settlement investments have allowed financial and banking institutions to not only buy their equity contractually, but also diversify their capital from any economic, market, and geopolitical risk. It's been part of the billion-dollar blueprint followed by institutional investors. And if you're an accredited investor, you can also now participate in this vehicle with enormous growth potential. You can watch an informational webinar presented by one of the premier organizations providing life settlement investments, Penumbra Solutions, at cashflowninja.com/life settlements.
And if it does, then the deflationary pressures from globalization will continue. And that will mean that it's not at all certain that we will end up with any significant inflation. We didn't after 2008, and we might not again this time. But even if we do end up with some inflation, then again, that's just going to be the price we have to pay, because some inflation is going to be a lot easier to live with than deflation, mass unemployment, and the social unrest and devastation that would result in if people start becoming hungry in the United States.
Yeah.
So, but the biggest question for everyone's future is, will there be inflation or not? And that's going to be determined largely as to whether or not globalization breaks down. So it's probably not a good idea to have an all-out Cold War with China at this point, and put up enormous trade deficits, trade barriers, because that would exacerbate the inflationary pressures. So that's something everyone needs to look out for. But yes, the inflation number is going to be very important, because if inflation goes up, then interest rates will go up. And if interest rates go up very much, then the stock market will go down a lot, and the property market will go down a lot. And that will be extraordinarily damaging for the economy, because then credit would contract. And as I mentioned earlier, we need credit growth to generate economic growth. And on top of that, asset prices would crash. And that would be a double blow, because we need the asset price inflation as a supplement to the weak credit growth.
And that's going to leave 76 million baby boomers, which the majority of their savings is in the stock market and their houses, and some pensions that are still left, with losing a lot of value in the places where they currently have it. So it could lead to a massive, massive retirement crisis.
Right. So when looking at the economic system that we have now, as I do, driven by credit growth and asset price inflation orchestrated by the Fed, the economy is being directed at the macro level by the government. The government does all it can to ensure that credit growth expands, and the Fed does all it can to ensure that the stock market and asset prices keep going up. So even back in early March, from March 1st, I wrote, at that point, the market was down 11% from its high, and it wasn't clear what was going to happen, but it didn't look good. And what I wrote was, look, if the market starts dropping 25, 30%, then the Fed, you can bet the Fed is going to be extraordinarily aggressive. They are going to do something, they're going to use all their power to their best of their ability, something completely unexpected and overwhelmingly powerful to try to push the stock market back up. Because if the stock market falls, the economy goes into severe recession. And sure enough, that is what happened. The Fed, on March 23rd, they announced what was effectively now is known as QE infinity. They would buy as many government bonds as necessary. And that worked. As of yesterday, NASDAQ hit a new all-time high. And the S&P and the Dow are pretty much even for the year, although not back to their February peak yet. But you have to wonder now, it's clear that the policymakers would like to see of course they want the economy to grow, and one of the easiest ways to make it grow is to have the stock prices go up. So you have to wonder if the stock market may not, there's a real possibility, despite the absolutely terrible fundamentals, with more than 13% unemployment and with corporate profits, they're going to be terrible. The fundamentals, it's hard to imagine them being worse. And yet here we are back at near record highs on the stock market. And looking ahead, and that's entirely due to all the paper money that the Fed has created. And looking ahead, it's almost certain that the Fed is going to create an enormous amount more of paper money over the next 6 months, a year. So you have to scratch your head and wonder, does this mean that the stock prices are going to go to even higher, crazier levels than they've already hit? And while I'm not recommending anybody do anything for that matter, I'm not recommending people buy stocks or anything else, but I'm just raising the point that you have to wonder if all this liquidity is going to push the markets to much higher levels. It's certainly a possibility that it will.
Yeah, we've seen some very interesting things. Folks have shared some articles even with me that you have companies that are filing for bankruptcy whose shares have gone up.
Right.
Like 170%, I think Hertz was up or something like that. It's just, you're seeing a lot of very, very strange things. That's a first for folks that have been trading and have been involved in the financial markets for 30 plus years.
Well, that's right. But, the Fed's total assets, which represent how much money the Fed has created, their total assets have expanded from $4.2 trillion in September to $7.1 trillion today. So that money is going into stocks.
Yep.
And it has to go somewhere. And so it's clearly pushing the stock market back up. Now, there's going to be some very, very bad corporate news and no doubt economic news. We saw some very bad numbers out of Europe yesterday. And when the banks report their results in the next quarter, I'm sure they're going to have some shockingly bad things to tell us. So it's going to be extremely interesting to see this battle between terrible fundamentals and this incredible surge of liquidity and how that's going to play out on the stock market.
Incredible things going on. So it's going to be very, very interesting, and it's been very, very interesting so far. It's been a pleasure having you on, Richard. Thank you so much.
Let me add just one more thing. I know this has been going on for a long time.
Yeah.
But if we come out on this, if we come out of this on the other side, hopefully this virus is going to go away. The good news in Thailand is there have been no locally transmitted cases here for the last 2 weeks. And something similar is the case in Hong Kong. So hopefully, like SARS died out in the summer, hopefully the same thing will be the case with this virus. Let's assume for the moment that the virus does go away and we return to something more close to normal. And we come out of this crisis, say a year or two from now, and the government debt, just for instance, let's say the government debt is expanded by $10 trillion and the Fed's the amount of money the Fed has created has expanded by $10 trillion. And we don't end up with high rates of inflation. Then what lesson should we learn from that? I think the lesson that we should learn from that is that we're living in a completely new economic environment now because of globalization. And what it means is that it is possible for the government to borrow and spend on a very large scale, and for the Fed to create money and finance that government borrowing on a very large scale without creating inflation, if that in fact happens. Therefore, we should do more. This means the US government could borrow and invest trillions of dollars in new industries and technologies, the industries of the future, so that we could induce a technological revolution. And for instance, over the next 10 years, I'd like to see the government invest $1 trillion in genetic engineering, another trillion in biotech, another trillion in artificial intelligence, another trillion in neural sciences, another trillion in green energy. So if we can, in other words, if we can get through this virus with a $10 trillion increase in government debt over 2 years, then surely the lesson from that is that over a 10-year period, we could invest another $10 trillion in the industries of the future in order to supercharge economic growth and productivity in the United States, resulting in extraordinary technological breakthroughs. $1 trillion is an enormous amount of money. We could now, for instance, National Cancer Institute, the main US agency delegated to try to cure cancer, their annual budget is $6 billion a year. Well, the Fed's creating $6 billion a year about every minute now, or every hour, certainly. So, 600,000 Americans die of cancer every year. $6 billion is not curing cancer. So let's try 60 billion or 100 billion a year. I mean, if we start throwing $1 trillion at research in genetic engineering and biotech, we really have the possibility of curing all the diseases and ending aging, potentially even reversing aging. We could bring about miracles with this level of investment that would not only in and of themselves be extraordinarily great by improving everyone's health and happiness and human well-being, but on top of that, it would shore up US national security. Because as things are going now, if you compare the rate that China is investing in research and development, they overtook US investment in research and development last year. If current trends continue, by the end of this decade, they'll be investing 40% more in 2030 than the US does. So at that rate, it won't be long before the United States becomes a vulnerable second-rate power at China's mercy, which is completely undesirable, unacceptable, and unnecessary, because we have the ability, I believe, and we'll soon find out, for the government to borrow on a very large scale and for the Fed to finance it without causing high rates of inflation. And if that's what we find a year or two from now, then we should recognize that lesson and make the most of it. Because, first of all, because it would enormously enhance human well-being. And secondly, it would prop up our economy and keep it from ever going into a depression. It would turbocharge economic growth and productivity. And also, it would support US national security, and we could lock in another American century.
Very, very interesting times ahead, and appreciate your insights. Richard, can you please share with my listeners and viewers where they can subscribe to your fantastic newsletter, MacroWatch, and where they can follow you and stay informed of all of the many projects that you're involved with?
Okay, thank you for that. My business is called MacroWatch. It's a video newsletter. Every 2 weeks, I upload a new video in which I make a PowerPoint presentation discussing something important happening in the global economy and how that's likely to impact